Uh, you have a brilliant way of building and sizing your investment position with options. And we've got to admit that we just cloned that idea from you. Matthew, the experienced investment professionals watching the show right now would like to know, how do you deal with options? Could you describe your process of selling puts in acquiring assets and covered calls to sell egregiously valued stocks through the Chicago Board Exchange with a hypothetical example? And you also have said that it is possible to take advantage of Alibaba shares with the same process. Could you lay that out for the audience?
Yeah, Ryan, absolutely. That's a great question. And so we're sort of switching now to focus on the activities of Peterson Capital Management and some of the strategies we use to acquire the great businesses that we're looking to build into the portfolio. There is a lot of background information available online. So I encourage folks to go out. They can look at our YouTube channel or even on our website, petersonfunds.com, or Peterson Capital Management can be searched on YouTube, and you'll find some of the core fundamentals behind this strategy. But I will explain them briefly here. Through traditional markets, New York Stock Exchange, et cetera, most professionals and retail investors use those methods to buy stock, as they have for decades and even centuries. So they'll use a market or limit order to acquire the shares. For almost a couple of decades now, I have only been buying shares through this alternative method, where we call it structured value, and we're basically using option contracts for their non-traditional use. So we are writing a cash-secured put contract as a tool to obtain the equity. What that means is, if you have a hypothetical stock that's saying shares say selling for $10 a share, and you're interested in buying them, instead of buying them through the New York Stock Exchange, you could write a commitment and sell it to a counterparty. Basically say, I'll buy your shares for $10 a share anytime over the next 6 months, and you have to pay us $2 for our commitment. We're ultimately insuring your shares, but we know quite a bit about your shares, by the way. So we know they're worth quite a bit more. So we're happy to collect your $2, hold our $8, and be prepared to buy your shares for $10 should you want to sell them to us for the life of the contract over the next 6 months. And it's ultimately a binomial outcome. If the market price of the stock is below what we've offered to buy them for, when the contract expires, the counterpart will sell us their stock. So in that scenario, they will put the shares to us. We will pay them $10, $2 of which was already their premium. And our net cash outflow to acquire the shares is $8 a share. So instead of buying them in the New York Stock Exchange for say 10 or maybe 9, we're moving in for 8 6 months later. Alternatively, if the market price is above the strike price of our put, the contract expires. And when the contract expires, nothing happens. It's over. We keep the premium that they paid, and the relationship ceases to exist. So we now have $2 that we've made on an $8 collateral over 6 months. So that internally to us looks like it's 25% and is a 25% gain in our capital. We've earned $2 on $8. We never own the stock, and this goes out for 6 months. And if we wish, we could sell a new contract. So this is the very standard practice we use to move into a new position. And also, I will add, we exit in the exact opposite manner. So after years and years, hopefully, of holding and compounding and all this growth, the firm is at and exceeding its intrinsic value, and it is time for an exit. If the shares have appreciated to, say, $80 per share, so they were originally at 100, and now they've appreciated to $800 per share, let's say we'll look to exit. So we will write a covered call. We will sell a call through the Chicago Board of Exchange that allows somebody else to buy our stock from us. And again, they pay us for that privilege. So as the shares run up, people are getting a little euphoric. Maybe they're willing to pay a little bit more for the shares, for the call option at this point that we are now selling. So as we go in, we could sell in New York Stock Exchange for, say, $800 a share. But instead, we go into the market, we say, oh, if we are willing to wait for another 6 months, the shares are selling for $800, maybe we could commit to selling it for $850 and receive a $50 premium. And then again, we have a binomial outcome. If the shares are above, if the market price of the stock is above $850, they will get called away from us. And we will have sold for $900, $850 plus the $50 in premium. If they don't make $850, contract's over, we keep the $50, we still have the shares, maybe they're now still at $825, we can go ahead and sell another contract. So we can continue writing these calls until the transaction is complete and we've exited. Now, what does that mean? That means the normal investor would buy these shares for 100 and then sell for 800. So, they would make 8 times their money, kind of a 700% gain. But we've constructed a way using the structured value approach to buy for 80 and sell for 900. Now, what that means is we're now making we're making 9 times our money, let's say for simplified math, instead of making 8 times our money. In fact, simplified math, I'm doing too much in my head. Let me just take a step back, guys. So instead, in the alternative situation, we are purchasing these for $80 a share, and then we're selling them for $900 per share. So in this case, we're clearly getting like 11 times plus our return instead of receiving only 8 times our money. And if this, say, takes a decade to unfold, you can work out the IRRs. If you make 11 times instead of 8 times over the same time frame, you end up with annualized IRR that greatly outperform your traditional professional investor, retail investor. So this approach is very advantageous. It directly impacts your IRR. You are literally getting into great positions for a lower amount of capital. You're lowering the denominator when you're calculating your returns. You're lowering the cost of your ultimate exit. And so it's so advantageous that even in a personal account, I would only do this. There's no desire for me to just buy stock in what I look at as a very old-fashioned traditional manner. So I know I went on for a long time with that example, and folks can go out and look at a lot of our material online. We've done some extended interviews specifically on that topic. But you asked directly about Baba, and Baba's a very interesting situation. Alibaba looks to become, it's becoming one of the global cloud players because of some things happening in China and in the tech space. So tech is kind of down, China's kind of down. They're actually quite reasonably priced, seem quite reasonably priced. And if you look up a bunch of different value investing 13Fs, you'll see Baba is appearing on quite a few. It's appearing in a lot of the portfolios of great fund managers. So Baba is very interesting. How could you go about applying this to Baba? So I think Baba is around $100 per share. I'm talking about the US ADR now is around $100 per share. And again, you could go, if the exact same scenario plays out, you can go and buy these. Instead of buying these for $100 a share through the traditional markets, you just simply write a put contract. And if you put that strike at 100, and your strike could vary, you could have a strike of 110 or a strike of 90. But if you put your strike at 100, you could possibly go out 6 months or so and ask for a price of $20. These contracts are very volatile, so you can put your price far outside of a bid-ask range that's available today. And over the next few days or week, or maybe month, there will be some trigger that moves the prices up, and you'll be waiting there, and somebody will buy your puts from you. Somebody will pay you $20 to buy Baba for say $100. And then the same scenario plays out. It's a binomial outcome. Either you make $20 on your 80 in collateral and you get 25% over the time period prior to expiration, or the alternative is that the shares decline a little bit and your counterpart puts them to you, which temporarily could make a slight decline. The shares have to go down, but in the long run, that's what you want to have. You want the shares. And we only do this when we want the shares. So we use this as a tool to buy the shares. And with Baba, you can use it right now in a very advantageous way. I think Charlie Munger started buying Baba around $200 per the ADRs in his daily journal company. Today, through what I've just explained, there's a really great way to get in for 80. So you're buying the same exact asset that Munger bought for a 60% discount to what Charlie Munger paid. So yeah, it's a pretty attractive situation.
No, absolutely, and it's a great insight, Matthew. While you're talking about this Alibaba stock, and also how you structured options to actually, but not going rather not going or leaving the purview of creating value. You utilized it as a tool to get a great discount while protecting the downside, and is still making an upside if that assumption doesn't work out. So this methodology is I think a great thing to study, though we possibly don't have this tool to apply to our market, but it's a great thing to learn, because I'm sure this will come sooner or later to this market.